Rising mortgage rates are threatening the spring housing market as the bond market refuses to provide any relief on the 10-year treasury yield. Will President Trump's economic policies help or hurt mortgage rates in 2025? We're going to look at all that in today's Mortgage Rate Outlook. Let's get into it. Welcome to Real Estate Watch, the channel that focuses on forward-looking real estate analysis for the U.S. and regional housing markets. If you're new to the channel, my name is Eric and I'm a professional economist in addition to being a licensed real estate agent, so I can bring you a unique perspective you'll be hard-pressed to find on other YouTube channels. We're looking at the 30-year mortgage rate today, which over the last few months has reversed course from the lower rates we saw last year, despite the Federal Reserve starting to cut their Fed funds rate. As of February 13th, the average rate on a 30-year fixed-rate mortgage was 6.87%, according to Freddie Mac, up from the recent low of 6.08% on September 26th, but still below the recent peak of 7.79% that we saw back in October of 2023. Why are mortgage rates trending higher even when the Federal Reserve is cutting rates, you might be asking? Well, there are a few reasons for it, and we got to look at the bond market for the 10-year Treasury yield, which heavily influences the 30-year mortgage rate. Treasury yields have been rising based on how bond traders view the outlook on inflation, the economy, and government debt. First, on inflation, there are fears that inflation is going to rise again, potentially causing the Fed to reverse course and perhaps raise their Fed funds rate again. We saw this play out in the release of the most recent inflation data last week. The Consumer Price Index for January increased by 3% over the same time last year, its highest reading since last June. It wasn't welcome news. If this is the start of a new trend, it could mean the Federal Reserve would need to reverse course. In response to the report, bond traders sent the yield on the 10-year Treasury to 4.637%, a tenth of a percentage point higher than the previous day and the highest rate in roughly 3 weeks. Thankfully, it has since come down a bit in the last few trading days, but it shows how sensitive the bond market is to unfavorable inflation reports. And that brings us to one of President Trump's policies that could have an impact on the bond market, mortgage rates, and the housing market: tariffs. Donald Trump loves tariffs. Now, I don't want to get into the politics of Trump's policies, whether they should happen or not, but I do want to look at what they mean for the housing market and the economy. Let's be clear on what a tariff is. If the U.S. imposes a 10% tariff on goods from China, for example, then the U.S. company that purchased those Chinese goods and imports them pays the tariff. Now, it is up to the U.S. company whether they want to raise the price for consumers here in the U.S., but most of the time the cost of the tariff is passed on to consumers so that the company can maintain profitability. Basically, tariffs increase the price of goods coming into this country. By their very nature, they are inflationary. Currently, we are in a situation where Trump is threatening a lot of tariffs, and some have been enacted, but not enough time has passed to see what the actual effect on prices is yet. But in a few months, we could start seeing those tariff costs putting upward pressure on consumer prices. Then the Federal Reserve will be in a tight situation and may need to raise their Fed funds rate again. All of this, as I'm sure you've guessed by now, would be bad for mortgage rates and the housing market. Rising inflation and the Fed reversing course would likely lead to bond traders sending the 10-year Treasury yield higher, and mortgage rates would then head higher as well. We have several months before all this plays out, and I'll be providing updates along the way to keep you informed, so make sure you're subscribed so you don't miss those videos when they come out. But there's another Trump policy that, strange as it seems, might actually help mortgage rates and the housing market: DOGE. The Department of Government Efficiency, or DOGE, headed by Elon Musk, has the central goal of reducing government spending. Elon Musk has stated that he wants to eliminate $2 trillion from government spending. It's quite a goal and may not be realistic, but Doge has been moving at breakneck speed since Trump was inaugurated a month ago. At this point, you might be wondering what Doge has to do with mortgage rates. That brings us to the other factors influencing the bond market: the economy and government debt. First, we'll discuss the government debt situation. The bond market has shown signs that it is increasingly concerned about our national debt, which is at about $36 trillion. The federal government is running deficits in the trillions of dollars each year, and just paying the interest on the current debt is costing about $1 trillion a year. To finance this, the government issues treasury bills, notes, and bonds, which adds even more to the debt. On the current trajectory, this is unsustainable. You can't just keep racking up debt on the national credit card without ever paying it off. The bond market knows this, and for taking this risk of a national debt crisis down the road, bond traders want higher yields for buying the treasuries. Enter Doge and Elon Musk's pipe dream of thinking he can fix this. Let's say hypothetically that Doge managed to bring down government spending enough that we didn't have a deficit and didn't have to issue more debt. It's an unlikely scenario, but let's say that it happened. The supply of new treasuries on the market would go down, which would cause bond prices to go up. Bond prices and yields go in opposite directions, so if bond prices go up, the yield would go down. As the 10-year treasury yield went down, so would mortgage rates, which would help the housing market. It's a far-fetched scenario, but that is how it could play out. There's the other side of this as well, the economy. The recent economic data has shown the U.S. economy exhibiting solid growth, and I covered this in my recent video on the topic. From the perspective of bond yields, this isn't necessarily a great thing. The idea is that if the economy is strong, the Fed won't have to cut their Fed funds rate anymore, so this puts upward pressure on the outlook for treasury yields. What does this have to do with Doge? Well, if Elon Musk did manage to cut $2 trillion in government spending, this would have an adverse effect on the economy. The massive deficits the federal government has been running over the last few years has had a stimulative effect on the economy. If you take away that constant stimulus, you could trigger an economic recession. The Fed would come to the rescue, hypothetically, and lower the Fed funds rate, and bond yields would come down and mortgage rates down with it. So theoretically speaking, if Doge were to cut significantly government spending, it could help mortgage rates by reducing the supply of new treasuries coming onto the market, as well as lower rates from the Fed by reducing economic activity. Again, it's a far-fetched scenario and unlikely to play out, but that would be one of the impacts of that Trump policy. Now, the flip side of that is you would have an economic recession on your hands, and those usually aren't good for the American people either. What do you think? Will Trump's policies on tariffs and government spending help or hurt the housing market through their impacts on mortgage rates? Let me know in the comments section down below. And if you want to stay up to date on whether Trump's policies are helping or hurting the economy and the housing market, make sure you are subscribed to this channel and hit that notification bell down below so you won't miss my next video on the topic when it comes out. I'll do the research for you, keep you informed along the way, and if you found this video useful or at least mildly entertaining, go ahead and hit that like button on your way out to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.